Welcome to this explainer. Today we are doing something really fun. We're putting energy giant ConocoPhillips through an absolute valuation gauntlet. We'll be stepping into the minds of legendary investors, extracting their strict criteria from our source data, and applying their precise frameworks to see if this stock is a hidden gem or just a value trap.
Here is our roadmap for the explainer. We'll start with the Buffett lens, pivot over to Peter Lynch and Benjamin Graham, run a rigorous DCF valuation, test out a couple of alternative models, and then wrap it all up with our final verdict. Let's dive in.
Section 1. Snapshot and the Buffett lens, moats and managers. Right out of the gate, ConocoPhillips is currently trading around $110.14 a share, and based on their latest Q1 earnings release, they are an absolute cash-generating machine. We're talking $1.89 in adjusted EPS and a massive $2.4 billion in free cash flow just for the quarter alone.
Now, this brilliantly illustrates Warren Buffett's very first criteria, the economic moat and financial stability. You know, Buffett demands a high return on capital and highly manageable debt. Well, ConocoPhillips boasts a proven 12% return on capital employed, which is a great indicator of how efficiently they use their money, even through volatile commodity cycles. Add an A-rated balance sheet with a super manageable 0.8x leverage ratio to the mix. Yeah, Buffett would absolutely be nodding his head at this.
Let's actually calculate Buffett's favorite metric, owner earnings. If we take their Q1 cash from operations, a whopping $5.4 billion, and subtract the $2.9 billion they spent on capital expenditures to maintain their competitive edge, we're left with roughly $2.5 billion in owner earnings per quarter. Annualize that, and the company is throwing off an estimated $10 billion in pure owner earnings every single year. Plus, management is showing real shareholder alignment here, committing to return 45% of that cash from operations straight back to the shareholders.
But we all know Buffett is incredibly disciplined. If we value those consistent cash flows, we get an estimated intrinsic value of roughly $112 per share. However, he always demands a strict margin of safety, typically around 25% for a commodity-dependent business like this one. Applying that discount, his hypothetical buy price triggers right around $84. So at $110 today, he's definitely staying on the sidelines.
Moving on to Section 2, the Peter Lynch lens, growth at a reasonable price. First off, Lynch would categorize the company as a cyclical stock simply because of its heavy reliance on macro oil prices. And the golden rule for cyclicals? You buy them when earnings are recovering and valuations are low. Right now, its forward PE sits at 11.33. That is a massive discount when you compare it to the broader oils and energy industry average of 19.26.
Running it through the rest of the Lynch checklist, we look at the PEG ratio, which compares PE to expected growth. The PEG is a very healthy 1.26, sitting well below the industry average of 1.92. The balance sheet is rock solid with $6.7 billion in cash. And you know Lynch loves improving efficiencies. CEO Ryan Lance is aggressively targeting $1 billion in cost cuts by 2026, right on the heels of their Marathon Oil integration.
So, based on this framework, Lynch would look at those heavily discounted valuation metrics, the fortress balance sheet, and the cost-cutting catalysts, and he'd likely call this a solid buy on any recent market dips.
Let's look at Section 3, the Benjamin Graham lens, the defensive investor.
Now, it's pretty rare, but ConocoPhillips actually passes Graham's incredibly demanding defensive checklist with flying colors. It easily passes the adequate size test, holding a mammoth $122 billion in total assets. The financials are strong with low leverage, earnings are adequately stable, its 5-year dividend growth rate of almost 14% proves an exceptional track record, and that 11.33 PE, it's perfectly moderate.
But Graham is ruthless when it comes to his intrinsic value formula. If we crunch his specific multiplier against their projected full-year EPS of $9.57, along with a proxy book value per share of $45 derived from their asset base, the math gives us an absolute fair value target of roughly $98.43 per share.
And here is the crucial point. Because the stock is currently trading around $110, there's literally zero margin of safety according to this defensive formula. Graham would view this as overvalued today. He'd adamantly hold out for a price drop below $75 before he'd even consider touching it.
Section 4. Base Case DCF Valuation, Projecting the Cash. Okay, time to strip away the philosophies and just run the raw numbers through a discounted cash flow model. To maintain absolute analytical integrity, let's explicitly state our assumptions.
We're taking that stellar Q1 free cash flow of $2.4 billion and annualizing it to $9.6 billion for our base year. We divide that by the 1,218 million shares outstanding. We'll apply an industry-standard 10% weighted average cost of capital as our discount rate and assume a modest 2% terminal growth rate using the perpetual growth method.
When we run a sensitivity analysis, the truth of the current stock price really comes out. Under our base case, right in the middle, that 10% WACC and 2% growth, the fair value lands at approximately $105 per share. What you should take away from this is that at its current $110 price tag, the market is pricing this stock almost perfectly. Maybe they're assuming slightly higher terminal growth or a slightly lower cost of capital. But honestly, it's fairly valued, plain and simple.
Moving on to Section 5, Dividends and Comparable Models.
Let's talk dividends for a second, because this is where the stock really shines for income investors. They boast a fantastic 13.94% 5-year dividend growth rate. They even recently bumped their quarterly payout to 84 cents, putting them on track for $3.36 per share annually. That consistent, aggressive growth feeds perfectly into a dividend discount model. If we run a strict DDM, assuming a generous 5% long-term growth rate against a 10% cost of equity, we get a highly conservative fair value of about $70. But if we flip the script and value them strictly against their peers using comparable multiples, applying that industry average 19.26 PEs to the expected 9.57 EPS, the model actually suggests it could be worth up to a staggering $184 per share.
Finally, Section 6, Synthesis and Final Verdict.
Let's synthesize our master scorecard here. It is a truly mixed bag. Peter Lynch and the comparable multiples model are screaming buy, highlighting a massive relative discount to the rest of the industry. But our value purists, Buffett, Graham, and the raw DCF model suggest the stock is fully priced, maybe even slightly overvalued today. They point firmly to a hold or even a void until a wider margin of safety opens up.
So, our final synthesized opinion for ConocoPhillips at $110. It's a hold. Make no mistake, the underlying business is phenomenal. They're our cash-generating machine, pumping out $10 billion in owner earnings with an impeccable balance sheet. But the macro risks are very real. They've suffered a 19% drop in realized prices recently, they're heavily dependent on WTI crude staying stable around $80, and they face ongoing geopolitical uncertainty impacting their Qatar volumes. For value purists, the upside at current pricing is just a bit too limited.
The investment gurus are demanding a price drop to that $75 to $84 range before they get off the bench. ConocoPhillips is undeniably a world-class operator, but discipline is what separates the legends from everybody else. So, the question I'll leave you with is this: at what price will you pull the trigger? Thanks for joining me on this explainer, and keep hunting for value.